At 5:32 on a rainy Thursday morning in Seattle, a 27-year-old freelance graphic designer gets a notification from his banking app while standing in line for coffee. His account balance is lower than expected, not because he spent recklessly, not because he forgot a bill. His savings account interest adjusted again, while his credit card rate quietly climbed higher. At the same time, the bank that pays him almost nothing to store his money is making billions lending money back to people at rates many Americans can barely keep up with anymore. And standing there in silence, he realizes something most people eventually feel in 2026. The bank is not designed to make him financially free. It is designed to make money from his financial behavior. That is the truth about banks most Americans slowly discover too late. Banks are not evil institutions secretly plotting against people, but they are businesses, and businesses are built to maximize profit, not optimize your financial independence. That distinction matters more than ever in 2026 because modern banking has become psychologically invisible. Most Americans interact with banks every single day without fully understanding the relationship they are inside. Your paycheck enters the system. Your savings sit inside the system. Your debt lives inside the system. Your mortgage, car loan, credit card, and transactions all move through institutions designed to profit from movement, borrowing, and dependency. That does not mean banks are unnecessary. It means people need to understand what role banks actually play in their financial lives. The average American still sees a bank as a safe place to store money. Wealthier Americans often see banks as tools to strategically use. That mindset difference changes outcomes dramatically. One person builds a life around borrowing carefully managed money. Another builds a life trying to escape borrowing entirely, while paying fees and interest at every level. In America, banks make the most money when people stay financially active but never fully financially free. Too much debt becomes risky. Too little debt becomes unprofitable. The ideal customer is someone permanently participating, always borrowing something, always financing something, always carrying some kind of monthly obligation. That is why convenience is prioritized everywhere. Tap to pay, buy now, pay later, instant approvals, seamless financing. The less friction attached to borrowing, the more profitable the behavior becomes. And before we break down how banks really operate in modern America and why understanding the system changes how you use money completely, hit like, subscribe to Andrew Finance, because this channel is built for people who want to understand how financial systems actually work behind the marketing. The truth about banks in 2026 is not hidden. Most people are simply too financially exhausted to stop and examine the relationship closely enough.
The biggest truth about banks in 2026 is that they profit more from behavior than from money itself. Most Americans think banks make money simply by holding deposits, but the real business is movement, borrowing, and financial dependency. A bank does not want your money sitting untouched forever. It wants activity, transactions, loans, interest payments, credit usage, financial products layered on top of each other over time. That is why modern banking feels less like a vault and more like an ecosystem designed to keep people financially engaged at every stage of life. A 44-year-old couple in Phoenix may have their paycheck deposited into the same bank that holds their mortgage, car loans, credit cards, and home equity line. Every financial movement flows through one system, collecting fees, interest, and data from nearly every decision they make. Again, this does not make banks evil. It makes them businesses, operating exactly as businesses are designed to operate. The problem is that many Americans still emotionally trust banks as financial guides when banks are structurally incentivized to increase profitable activity, not necessarily reduce dependency. That is why banks heavily market products tied to borrowing and convenience. Credit cards with rewards, personal loans for vacations, financing for almost everything, easy approvals, flexible payments. The messaging is psychological, makes spending feel painless and borrowing feels normal. This is one reason consumer debt keeps growing even among households earning decent incomes. The financial system rewards participation, and participation often means carrying obligations for years. Banks also understand something powerful about human behavior. Most people care more about monthly affordability than total cost, so products are designed around manageable payments instead of long-term financial impact. A person may focus on whether a car payment fits the month, not what years of interest actually cost. A homeowner may focus on qualifying for a mortgage, not how much lifetime interest will eventually leave their pocket. This psychological framing matters enormously because it shapes how Americans experience debt emotionally. If the monthly payment feels survivable, the total burden becomes psychologically invisible. That is one of the most effective systems modern banking relies on. Small monthly obligations spread across years feel emotionally lighter than one large number shown honestly up front. And once people become comfortable living through monthly payments, financial dependency quietly becomes normalized without most households fully noticing it happening.
Another truth about banks in 2026 is that wealthy Americans often use banks completely differently than the average person does. The average household usually interacts with banks defensively. They use banks to store paychecks, manage bills, borrow money when needed, and survive financial pressure. Wealthier households often interact with banks strategically. They use banks to preserve liquidity, access leverage, structure investments, and increase financial flexibility without necessarily selling assets. That is a massive difference. A middle-class worker may see debt as a burden to escape. A wealthy investor may see certain types of debt as tools that allow them to keep appreciating assets while still accessing cash. This is why two people can use the same banking system and experience completely different financial outcomes. One pays interest most of their life, the other uses leverage to expand ownership faster than their cash alone would allow. A business owner in Miami might use a line of credit to acquire another profitable business while keeping existing investments growing. Meanwhile, another person uses credit cards simply to survive rising living costs month to month. Same system, completely different relationship with money. Banks reward the second type of customer differently because asset-backed clients are less risky and often more profitable long-term. This is another uncomfortable reality many Americans slowly notice. The banking system often becomes easier, cheaper, and more flexible once you already have money. Lower borrowing rates, better financial products, stronger investment access, personalized services. Meanwhile, people under financial pressure usually face higher interest rates, stricter penalties, and fewer options. That creates a cycle where financial stability improves access, while financial instability increases cost. This is not only about economics, it is also about risk management. Banks trust collateral more than promises. Someone with strong assets and stable cash flow is viewed differently than someone living paycheck to paycheck, even if both work equally hard. That is why understanding banking psychologically matters. Banks are not judging morality, they are measuring risk and profitability. And once people understand that, they stop viewing banks emotionally and start viewing them strategically. The wealthy rarely see banks as financial protectors, they see them as financial tools. That mindset changes behavior completely. Instead of asking what the bank can approve, they ask whether the financial structure actually strengthens long-term control. And in 2026, that difference between emotional borrowing and strategic borrowing is becoming one of the clearest financial divides in America.
The most important truth about banks in 2026 is that financial freedom usually begins the moment people stop blindly participating in every financial product offered to them. That is the real shift. Banks are useful tools, but they become dangerous when people confuse convenience with financial progress. Just because you can finance something does not mean you can truly afford it. Just because a bank approves a loan does not mean the loan improves your life long term. And just because monthly payments feel manageable does not mean the financial structure underneath them is healthy. A 31-year-old restaurant manager in Nashville realizes this after years of living entirely through monthly obligations: car payment, credit card balances, furniture financing, personal loan. Everything technically affordable month to month, yet financially exhausting altogether. For the first time, he stops asking what he qualifies for and starts asking what actually increases his long-term control. That question changes his behavior completely. He pays down high-interest debt, reduces unnecessary borrowing, builds savings, and stops treating financing like normal adulthood. That is when banks stop controlling his financial behavior emotionally. This is the deeper psychological shift most Americans eventually need. Banks should support your financial life, not quietly own most of your future income. The problem is not banking itself. The problem is unconscious dependency. Too many people build lifestyles entirely dependent on borrowed money, then wonder why they never feel financially stable, despite working constantly. Financial peace usually begins when income starts building ownership instead of endlessly servicing obligations. That is why wealthy households often interact with banks from positions of leverage, while struggling households interact with them from positions of survival. One side uses the system strategically, the other side gets consumed by it emotionally. Understanding this does not require hating banks. It requires seeing the relationship clearly. Banks are businesses optimized around profitable financial behavior. Your responsibility is making sure your behavior benefits you too. That means understanding interest, questioning debt, protecting cash flow, building assets, and avoiding financial structures that permanently trap your income into repayment cycles. If this changed how you think about banks in America, like, subscribe, and follow Andrew Finance for more real-world financial psychology, smarter money systems, and practical insights designed for people who want to understand how the financial world actually works instead of just surviving inside it.